volatility is something that's everywhere in market. It is the epicenter of markets. I think a lot of people would consider it, but I don't think people really give it the emphasis.
Chris, I'm so sorry to interrupt you. I'm so sorry to interrupt you, but there's actually the first question is really the most important, because we're talking to a retail crowd here, and
yep.
making an assumption here that everybody understands what volatility is. So perhaps just for maybe a minute, you could define for everybody who's new to the market, what is volatility? Actually, what is volatility as a definition? And then we'll go on from there.
Well, actually, I'm actually going to define volatility in all different capacities throughout this. So I will answer that question. So you have to bear with me, Boris, and I will thoroughly answer that question. So it's kind of like the epicenter of my discussion. So leave it with me, and we'll go through that question. By the end of it, people should have a pretty good idea what volatility is. Okay, so volatility. Before I actually go into the crux of realized volatility, something that Daryl was talking about with average true range and Bollinger Bands and envelopes and bits and pieces. Volatility is everywhere. You know, it is all around you in the financial markets. It's involved with speculation. It's involved with hedging. It's a major contribution towards your risk management and your position sizing. Volatility is the defining contributor towards your strategy. Whether you're in the carry trade or unwinding the carry trade, it involves what instruments you're going to be using at the moment. You know, you've seen this big bid in the Swiss franc and the Japanese yen because times are looking pretty tough. We've seen higher implied volatility in the markets. So it defines not just your strategy, but it defines what instruments you're trading, the direction of those trades. It defines the level of risk that you're going to be taking on. And really today, that's kind of the concept that I want to bring out to you is how you can use volatility, understand it, harness it, and use volatility as a weapon for better risk management and correct position sizing. Now, they're two of the biggest aspects for trading, and I want to show you how you can use volatility as a new tool to get better risk management and achieve that correct position sizing, which of course is so essential in trading. But also when we can understand what is expected in the market in terms of the potential moves, the implied volatility, which we'll discuss in greater depth soon. You know, for people out there who are running expert advisors algorithms, for example, one of the biggest killers of accounts that we see are people who don't adjust to market rhythm and market structure, and their algo and their expert advisor is not an automated, it's not an artificial intelligence. It doesn't adapt. It does what it's told. And if the market conditions change, then you know the algo will perform differently. So what we want to do is we want to come up with a structure that can give you a higher positive expectancy for your algo. If you know what it's supposed to achieve, if it does well in higher volatility markets, you know, you can have greater confidence to keep your algo running in that situation, or potentially even increase the position sizing around that. Or if you know that the market or the market's telling you that the conditions are not particularly great, perhaps you can tone down or even turn off your EA because the potential for losses is going to be increasing. So if you know what it's going to try and achieve, that's what we're trying to achieve today. So, you know, it is everywhere. And, you know, one of the things that we've been just trying to keep on the structure of the market and the strategy in the market. One of the things that I think that we've looked at very closely this week is the rise, obviously, in trade sanctions and trade tensions and the higher volatility. The VIX index, which is the implied volatility in the S&P over the coming 30 days, you know, just to give you an idea of strategy, and I'm not going to go into too much depth about this, but you know, the carry trade is something that we see a lot of from clients, and it's something that hedge funds really apply, where they're looking to go into buy the high yielding assets and look to fund it with the likes of the euro, the Swiss franc, and the Japanese yen. Well, look what's happened with the volatility index, the VIX, which is around the S&P, but it has a big ramifications in the S&P in FX markets. You can see here that the VIX has gone up. We've actually inverted this. And you can see that the carry trade has come unwound pretty quickly. You can see that the implications here for strategy is very, very clear. And I think this is one of the most pertinent things that we've seen. People who've been buying the dollar because they want to get paid in that funding position, will know so that position's unwound very quickly. So, you know, we keep an eye very closely on what's happened in the VIX in FX. But what I want to do today is really explore a report that I've been putting out to clients, and I think this is the sort of the thing that I look at the beginning of the week, and it sets my world. It sets me how I understand you know, the markets at this one stage. We're looking ahead at all the bent risk that's coming through, and this is kind of what I want to explore, how I make this report, what it actually means, and how you could potentially use this to better benefit your trading as well. So what we're going to do is we're going to look at how this report works, and then we're going to explore into realized volatility, and then we're going to explore into implied volatility. So to answer Boris's first question, you know, what is volatility? Well, volatility is twofold: realized and implied volatility. Now, Daryl talked about average true range, and you can see here in the a few G10 currencies that I've looked at, we've looked at the 5-day ATR and the sort of moves that we've been seeing. And a lot of people will use that as a risk management tool. You know, we've got a lot of people who would probably say, well, the ATRs are, you know, on dollar CAD 61 points, so I'm going to leave my stop loss 1.5 times ATR. Gives me a bit of breathing room. I might be trading off daily charts, weekly charts, but it gives me that little bit of breathing room. Some people will use Bollinger Bands, which represent 2 standard deviations from the 20-day moving average. And again, I've just defined them here. But realized volatility is fact, and it's statistical fact. I want to look at what's actually the market's implying and going forward. And so I use the at the money implied volatility. So I'll explain what all this is. At the moment, these are just a bunch of numbers. And then we percentile rank this to give you some context. So this is the annualized standard deviation percentage expected return up or down for a currency over the week or over the weekly time frame. I'll explain a bit more what this actually is in layman's terms for you. But what we do then is we look at the implied volatility rank. What is that? The expected move that the market's implying from spot. So rather than use what's actually happened, this is what the market's implying. So how will we come about getting that? So the expected range based on the options market, and then we can take our implied volatility out or our expected confidence out, and we can actually look for extreme moves which the market's pricing. We can have a look at volatility reads for the VIX, for oil, and also for Treasury futures. I think they're absolutely fundamental to understand how these work for FX markets. I just showed you the impact that the volatility index in the S&P has on carry positions. So the VIX index, for people who are new to it, is an instrument that we'll be rolling out on Pepperstone fairly soon. But what it is, it's a group of options that are used on the S&P, so S&P options. And they expire on Fridays. They use only Friday options, and they use 23-day expiries and up to 37-day expiries. And what they do is they use a blend of different expiries to come up with like a weighted yield, effectively a constant 30-day implied volatility. So for what it is it's using different strikes and different expiries to come up with a weighted implied volatility for the S&P. And they call that the VIX index. And what we do there is we look at that number, that is an implied volatility over a standard over a year. And then we actually imply volatility rank that at 0 to 100. At the moment, that's at the 28th percentile. So what we're doing is we're using this report. Then we look at risk reversals. What are risk reversals? You know, what are they actually expected to show? We have a look at the commitment of traders report. Again, this goes into our risk reward. And then at the start of the week, we look at the expected move, the implied probability of a rate cut by a specific time. So we've got the RBA, the next meeting in September, there's a 46% chance. We've got 59 basis points of cuts being priced in by over 12 months. And this gives me my holistic view on markets. And this is what we put out to clients. It gives me everything that I need to know at the beginning of the week. So let's go through what this means. Okay, realized volatility. Realized volatility is something that probably most technical traders would have used. It is a volatility measure based on statistical fact. It looks at the dispersions of price and the returns from a mean over a specific period. If price is pulling away from a mean, we're getting dispersions in those price. You're seeing high volatility. Volatility can increase when prices are going up, and it can increase when prices are going down. It's almost universally agreed that volatility, when you see higher volatility, most people say, oh, the market's crashing and we're seeing higher volatility. Well, you can actually see volatility increase when prices are going up. All we're saying is that the dispersions of those prices relative to the average are increasing, and they're moving sporadically across wider relative to whatever that mean of the period is. So that is statistical volatility. We can see that in realized volatility. Probably one of the best ways to look at realized volatility. And for people who are looking, there is an element of maths involved in this, and I apologize for that, but I think what we want to do is we want to plant a seed. We want you to sort of go away and really kind of, if you're interested in what you're hearing here on the statistical front, there's a lot of research we can put you in touch with and show you this, because these indicators, you're using them every day, but actually what do they mean? And in terms of the Bollinger Band, one of the most used ones there, really great tool for people who are using mean reversion strategies. You've got a sideways trending market, you've got the 20-day moving average moving pretty much perfectly sideways, you've got the RSI around sort of hovering around mid-range. You do get a lot of people looking to fade moves into the top Bollinger Band or look to buy into the lower Bollinger Band. And why do people do that? Well, because it's statistical. When you look at the normal distribution or a bell-shaped curve here, you can see the average line here. And these prices, they're moving one way or another from the mean. And these, price close, and the price closes here, but those dispersions of prices, statistically in a normal distribution where there's randomness, you will see those prices contained with one standard deviation. 68.2% of those price will be contained within that one standard deviation. Statistically, 95.4% of price moves will be contained within 2 standard deviations. This is why we use Bollinger Bands, because statistically, prices very rarely go above 2 standard deviations from a mean. The standard deviation is a way of calculating those changes from a price mean. This is why people look to fade it into there, because we can say with a level of confidence of 95.4% that the market really shouldn't go too much further than this unless we're looking to see something that's new. 99.7% above 3 standard deviations. The average true range is a way of looking at what's happened. This is statistical fact. And Daryl's got a strategy there which uses average true range. It's back tested by the sounds of things. He's got a statistical edge. That's fantastic. Continue to work that. What I want to look at though is implied volatility. Rather than looking backwards at what's actually happened, I want to actually say to myself, what does the market think about what's going to happen? What does the market say? We think this is going to happen in the future. And that's why we can use implied volatility really well, whether we're looking at implied volatility around an FX market, a certain currency, whether it's around an index, around a commodity. It works on stocks. This whole procedure works on every asset class in terms of rates, fixed income. We can look at what the market is telling us around a certain event, around a certain date, a certain week, over a certain period. And they can be wrong. That's why people buy and sell volatility. But rather than us take a decision, we can actually understand what the market is telling us going forward. Implied volatility for the statistical heads out there is expressed as 1 standard deviation annualized percentage change of an underlying with a 68.2% level of confidence. What does that actually mean in layman's terms? Well, it's the trader's perceived future movement or volatility in an instrument's price over a predetermined period. But this top point is really important because implied volatility is expressed as an annualized percentage change. That's really key. When you see a number, 16%, it's an annualized number, a percentage change or expected percentage change over that time. Now, this bottom point is really key here. Implied volatility is based on changes in options prices. Those options prices, let's call it at the money. Let's use an at the money option. And an at the money option for people who are new to options is simply a strike of the option, which is trading pretty much at the current market price. It's at the money. So the expiry is trading at where the market is trading. If there's more demand for those options, if there's more demand for the options, the higher the implied volatility. People are paying up for those prices. It's increasing the implied volatility because people are saying the option has more chance of being in the money. You're not going to pay up for an option if you don't believe that there's a good chance of it being in the money. If you think that there's going to be a big move, you're going to buy that option. And therefore, you're going to pay more, and that's going to increase the implied volatility. So implied volatility is based on changes in options prices. A lot of people see it the other way around. But I think, if you actually look at it, options prices drive implied volatility, and that's really key. Let's have a look at an example here. The Aussie dollar trading at 70 cents. I know it's trading lower now, but I've used this as a nice round number. And the market has given this a 10% implied volatility, where we're going to use annual options. So these expire in 1 year time, in 1 year's time. We're using an annualized implied volatility of 10%. Remember, this is a standard deviation, which gives you that 68.2%, one standard deviation. This is considered a 10%. So over that course of the year, the markets looked at everything that they can see ahead of them, every single thing that they think is going to influence the Australian dollar, be it Aussie data, Chinese data, US data, some sort of political event. And you can see that the market is saying everything that we know with this 10% implied volatility based on those annualized options, that we're going to see it trade down to 63 cents or down to 77 cents. Something happens. The market says, well, actually, do you know what? Things are really going to kick off in Australia. We're expecting some big moves in the Aussie dollar. Those options prices are going higher. This is an at the money implied volatility annualized. Okay, so the market is now saying we expect to see a massive move, and therefore you can see this 20% implied volatility. The market is now saying something has changed and the implied volatility has gone up to 20%. The implied move, therefore, this is one standard deviation, is down to 56 cents or 84 cents. Now that's an annualized move on an annual option. We can change that, and we will change that. And in this case, we don't trade currencies for a year. We don't trade an index for a year. Very rarely do we do so with leverage. We tend to trade for, I think the average hold time at Pepperstone is something like 4 hours. But, personally, when I'm doing this, I like to trade, I probably trade anywhere between 2 days up to 1 week. So I won't use annualized or options that go on for a year. I'll tend to look at options that last 1 week. And my whole presentation today is really based on what's ahead for the week. If I go back to that spreadsheet, it's around what's the expected over the course of the week. We put it out on a Monday so that people can get a sense of what the market's expecting for the week ahead. Now, if I have a look at implied volatility, we can see this, this was a couple of weeks ago, but I just wanted to give you a sense of the implied volatility, which we can chart. At that time, we could see that 1 week implied volatility. So we're using options on the Australian dollar that expire in 1 week. This is at the money. So the strikes on this are at where the current market price is. Now, remember this number here, 5.6725%, is an annualized number. It's an annualized number, but it represents the options that are taking place that expire within that 1 week period. And what we're trying to do is we're trying to get context on that implied volatility. The market has looked ahead at the week that will be starting on Monday and said, we've got this data point in Australia, we've got this in the US, we've seen the journey that we've been on, and we'll take that on board as well with realized volatility. But we're looking ahead, and we're going to give this a 5.67525 implied volatility. Now, what we do is we try and get context on that. What's that actually mean? Well, the market's saying here that that we could see over the course of the year, if this was to be held for, if it was a yearly option, this would move 5.6725%, which doesn't sound like a lot. But we don't need to put on context, and this is what IV rank, implied volatility rank, does. It puts it into the range of the high to the low. So the calculation we're using to get implied volatility rank is the current implied volatility, which you can see there, 5.675%, take away the absolute low and divide that by the difference of the high to low range. And that gives us the second percentile. So what we're trying to understand is the market's looked ahead at the coming week and said, well, a 5.67525%, that's the second percentile. We don't expect much of a move. We don't expect fireworks to come through. In fact, if I go to my spreadsheet, we can see there that annualized move. If we want to try and actually want to take this down to a weekly one, so we know that that's a weekly option, but it's an annualized figure. If we actually want to take that annualized move down to a weekly move, we can just do it with a trickery, and we just need to do it a square root there. So it's a little bit of maths involved, but we know that volatility is the square root of time. Now we know there's 50 weeks in a year, 50 trading weeks in a year. So we're just taking that number there, that 5.675%, and we're going to square root that by 50. And what we find then is that the implied volatility on a weekly basis the expected move on a weekly basis is 0.8. So the expected move on an annualized basis is 5.675%. Now, what we can actually do is we can work out the expected move from this by simply going here and getting the market price, which we see at the current market price now, which is 67.86, timesing that by 10,000, and then timesing that by the weekly move, and that will give us the implied move of 54 points on the week. So it sounds quite complicated, but all we know is that that's an annualized move expressed. So we can take that down to a weekly move, and then we can actually say, well, what is the expected move, up or down? And implied volatility is agnostic in terms of direction. It can be up and it can be down. It doesn't have to, volatility doesn't tell you where the market's going. It just tells you the extent of a potential move over that period. So that's what this does with an annualized move, which we can take down to weekly moves just by square rooting it, but it gives you a context of where the implied volatility. We can get implied volatility for overnight options. So this is really good if you're trying to assess an event risk the night before. If I come in and have a look at the RBA announcement, and it's in the morning, for example, 2:30 is the announcement. We could come in at 10 o'clock and say, well, what's the implied volatility on the day, and get a sense of whether the market thinks there's going to be a big move on the day by having a look at the implied volatility. Traders are betting or speculating on those daily options and actually saying, well, you know, if we think there's going to be a big move, then of course you're going to go and buy those options. And that's where this implied volatility rank really comes in. It gives you that context you're looking for. Everyone looks at the commitment of traders report, but I want to have a look at this thing called the volatility smile. It's called risk reversals. And again, you come to my spreadsheet and you can see, let me just bring up the spreadsheet. You can see in that bottom left corner the risk reversals. So what are risk reversals? What does that actually mean? Because to me, they are one of the best guides for sentiment that you can possibly get out there. Getting that information is very difficult unless you're actually trading with an options broker, but we can apply this to our just generic FX trading and our normal commodities trading, just by getting a sense of how the market is structured and where they see the potential moves going. We can see here that at the money implied option for the week, 5.675%. There it is there. You can see it at the money. Now, what we've got here is a structure of the market in terms of the deltas. The delta in an option is simply the rate of change that we see relative in the options price relative to the underlying. So if the Aussie dollar is going up by 1% and we've got a 25 delta call here, the option is going up by 0.25 of 1%. And very simply, well, we're not really too concerned about that. What we are concerned about is the fact that deltas give us an implied probability of the move actually taking place. For example, a 25 delta put, whatever that expiry is or whatever that strike price is, we don't know what that is at the moment, but the 25 delta put is basically saying, the market is saying whatever that strike is, there is a 25% chance of that strike being in the money. The market is giving you categoric levels by which you can define this by. You know, we look at our spot FX trading, our commodities trading, and you know, it's really difficult to put statistical numbers on things. That's where the options market comes in really well. You know, it is based on maths, it's based on statistics. So we can actually come out with statistical numbers that people, you know, market makers and the market through supply and demand give us, and we can actually quantify various levels in the market. And what we can see here is if we go out to the various deltas, a 10p means whatever the strike is at that time, there is a 10% chance of that being in the money. That's obviously very low. We don't know what that strike is, and frankly, we don't really care. What we're saying is to go out and find us a strike that has a 10% chance of being in the money. You can see the other side of that on this side here, 10 delta call. So puts give you the right to sell, they're bearish. 10 delta calls give you the right to buy. And what we're trying to do is trying to understand how the market's structured. It's called the skew. These are risk reversals. And you can see here at the moment in the Aussie dollar, if we go out to a 25 delta, so slightly out the money, the market's giving us a 25% chance of actually getting in the money. You can see that the implied volatility, the annualized number for that week, is 5.89%. You can go here and look at the call, which is the mirror opposite, a bullish structure here for the Aussie dollar over 1 week, and you can see that 5.71%. So people are paying a higher level for options in this 25 delta put relative to calls. So how am I looking at this at the beginning of the week? Well, the market's saying to me that there's more downside risk and they're prepared to pay higher volatility for downside protection. You go out to the 10 deltas, which is a really strong outlier move, and you can see here that the market is saying that there's they're putting us an annualized volatility at 6.2% relative to 5.89%. So if you take away that via that, you can see that the skew is negative, and that's why these risk reversals are really great tools, because they give you a sense of what the market is expecting. Where is the risk lying in terms of the direction going forward. So what we can do now is we can use those concepts to give us an implied move over a period. And what we do there is using that implied volatility. That implied volatility, as I showed you with the spreadsheet, gives you an expected move up or down. But what that implied volatility doesn't take into consideration is things like the risk-free rate. It kind of over-exaggerates things a little bit. And we wanted to know what the market's prepared to pay to buy volatility, and we can use that in our risk management. So what we do is I'm going to ask the system, and in this case it's Bloomberg, just to tell us what the market's expecting for an exact move over the week. There's our implied volatility. The midpoint of that is the number that we've used, 5.625%. We can see here, this is the strike of the option, which is pretty much there. It's at the money. The strike is at the money there. We can see this expiring in 1 week. This was when I did the situation there. And then we've used the risk-free rate, which I'm not sure what Bloomberg used, but they've probably, it's very low. And then they've added this all together and they've come up with this number here, 47 points. The market's saying we are prepared. We think that the Aussie dollar, based on all this information that we know going forward in this week, all the data, all the event risk, is going to trade 47 points from spot, up or down. So that's with a 68.2% level of confidence. Because we're using implied volatility that's at the money, this is giving us a 1 standard deviation move. So remember that 68.2% chance of being in the money. The market is giving us 47 points. If we go to the payoff diagram, just to show you how this works in principle, you can see here that the current price at the time was 70.31. The market was prepared to pay 47 points. So you can see it goes down to 69.84, but they think volatility is agnostic. It can be either direction. And you can see here that the market thinks on that side that it could be as high as 47 points that way. So when you're buying volatility, you don't care which way it goes. You just want a big move, and you make money if your position or the market trades a lot higher than this. But the market has said everything that we know with that implied level of volatility that we're going to trade in this range here. That the vol sellers are going to expect to see it trade below this level here. But the vol buyers, the volatility buyers, would expect a bigger move here. But the market is telling me I'm not trading volatility. I just want to know for my own risk benefit the expected move, and we can see a 47-point move here. What we can also do then is actually use this other strategy called a strangle. And what a strangle does is, rather than use an at the money implied volatility, we can take our level of confidence out. We can say, give us an extreme move. That one there was using a 50 delta effectively. But I'm saying to the system, what, go out and find something that potentially is an extreme move. And what we've got here is a different method called a strangle price. And what it does is we've asked the system to go out and find us a strike with a 10 delta, a strike which the market gives a statistical level of 10% of being in the money. And what the system has shown us there is that option, the call, is 71.11. So it needs to trade up to 71.11, or on the put side, 69.60. And you add the premium. The premium there, you can see, is very low compared to 47 points on the last one, which was a 50-50 bet effectively. But what you've got there is, because there's only a 10% chance of actually this being in the money, the market's very low premium. So to make money on this trade, you have to add the premium with the potential move to those different strikes. So what we got is the situation here on the payoff diagram where I know, based on what we're seeing there, that the market is expecting the price to trade to 69.54 or up to 71.16. And that's with a 90% level of confidence, because there's only a 10% chance of that being in the money because it's 10 delta. And therefore, there's an 80% chance of it staying within this range. Now, how does that look like to me? And I'm sort of rushing through this because this sort of presentation does take a lot longer. But when I look at this at the beginning of the week, this is what I look at. So the market has told me that they see with a 69.8% level of 68.2% level of statistical confidence. Remember, that's a 1 standard deviation move, and at the money is is 1 standard deviation, that it's going to trade 69.84 to 70.78. Or if I take that strangle pricing out to a 10 delta, which gives me a 90% level of confidence up to this level, and a 90% level of confidence down to this level that it's not going to move any further, well, then you've got the price trading 69.54 to 70.11. So that's what it feels like to me. You know, if I was running an expert advisor, I would say to myself, well, actually, I'm quite happy with the market trading in these levels. I can put a statistical level of confidence around that. And then, you know, I'd be happy to run my EA. Remember, the implied volatility was at the 2nd percentile. The market's not expecting big moves there. So we've got this statistical level which is in the market. We're looking forward and the market's telling us what they think. Rather than use your own initiative, let the market tell you what they think around all the event risk. And you can actually put this playbook into practice using statistical probability of what the market would pay. I'm not going to go into there. Okay, I'm going to give you an example about how I saw the Fed meeting. I'm going to put this into practice. Okay, so the first thing I did is I came in on the Monday morning and I said to myself, well, you know, we've got a Fed meeting on Friday. What is the first thing I asked is what is the number of basis points being priced into the Fed funds market? Now, I want to understand what's being priced in here, and you can see here that the Fed funds market is pricing in 118 basis, one full rate cut, and 18 basis points, 18% chance more. So I knew that there was a pretty good chance that the Fed were going to cut rates, but also there was a bit more being priced in. I looked at what the economists were calling, and I could see that the most economists were calling for 25 basis points. There was a number of 10 or so who were calling for rates to be kept on hold. You know, those people clearly didn't listen to a single thing the Fed was saying. And there was a couple who were calling for 50 basis points. But I'm trying to understand my probability setting for the beginning of the week and how markets may act based on what's being priced in. So there was a full rate cut was being priced in. There was an 18% chance of a 50 basis point cut. How's the dollar? How are the markets going to react on the back of that? I've chosen dollar yen here to look at because I think it's the most clean version of how the markets would trade. It's probably the closest line to US Treasury yields. And what we looked at on the Monday was was dollar yen weekly volatility annualized at 6.3150. Now, considering we've got the most anticipated Fed meeting, you know, for many years, they're going to cut rates first time in a decade. The implied volatility was at 32 percentile. So I was telling clients, you know, look, we've got this massive event, but the market's not expecting fireworks. You can see here the average line, this blue lotted line, they've got 1 standard deviation here. So it's really around average of where we've been over the last 12 months. I mean, I can take the context lower and I can look at how things have been going in the last couple of months or so. But over the last 12 months, which is really where you look at the implied vol rank, you can see that it's actually not high. So immediately I thought, well, you know, lots being priced in. The market's not implying a big move. You know, we had a lot of clients who were saying, yeah, we're going to see fireworks this week. We're going to get a rate cut. And I'm like, well, actually, the market's not telling me that. I can look at my system. I can look at the at the money straddle price, and I can see that the strike there, 108.55. It's at the money. It's the closest one they could find. I can see my expiry there. I can see that level of implied volatility, which we had, 6.315. We've applied that to the system. And the market said over the course of the week, we expect a 75-point move up or down. You know, so the market's told me, well, we're going to get a 75-point move. Now, you can go and buy and sell volatility based on that in the options market, but we're not trying to do that. We're just trying to anticipate the expected move over the Fed meeting and all the other data points that come through. You can see there from the current at the money spot level that that's the kind of moves we're expecting, 150-point range effectively in that situation. But then I say to myself, well, actually, you know, that's a 68.1% or 68.2% level of confidence. Go out to the system and give me a really big move. Tell me what an outlier move would look like in that situation. And you've got the market trading at 108.67. We've taken our deltas out to 10. So we've found strikes, which you can see here, which have a 10% chance of being in the money, or the market's applying a 10% chance of being in the money. And you said there 109.80 to 107.19. If you add the premium to both legs, you've got a situation where the market's saying that we probably go down to 107.05 and 109.93. So what does that look like? That's just what this looks like. At the beginning of the week here, This is what I was looking at. So we saw with what the market was telling me with a 68.2% level of confidence that we would trade up to 109.30 and down to 107.80 with an 80% level or 90% level of confidence getting up to the top, or a 90% level of confidence getting down to the bottom, that it wouldn't trade any further than these points. If you did, you go and buy volatility, that it would stay on an 80% level of being in this range here. This is just Bollinger Band. So again, this is realized volatility. But you can see here that the market is saying that we expect to stay within this range. So, I was looking at my risk and I was saying, well, actually, if I was going to be in a position, if I held a position, this is kind of the level that I'd be looking at having a stop. Now, you'd obviously look for a natural point below a specific market pivot or a retracement level. But I could say here with a statistical level, the market has told me that they see this as being an extreme move on the week. And therefore, I could have some pretty good confidence that I could have my stop loss below this level if I'm long. And you've got obviously got this nice resist support levels that are kicked in, but the market has given me a statistical degree of confidence of how far I can have my stop loss. And of course, in that situation, when you're taking more or less risk on, then you can adjust your position size accordingly, and you can see the levels there. So what I'm trying to understand is what the market's telling me. I can put that through the system, and it will give me an expected move. The next thing I look at is non-commercial, so looking at where the market's positioned. At the time, the market was a little bit on the short side. You can see 9,000 short, so it's not really giving me much. We're going into the beginning of the week on dollar yen, but again, you could have applied this to gold, you could have applied this to treasury markets, you could apply this to S&P. This whole holistic stance on how you're reviewing the market at the beginning of the week, you can do with all these different assets. And you can see here, the market was pretty neutral, so it really wasn't giving me too much, but it was part of my holistic assessment of dollar yen. I can have a look at risk reversals, and you can see here that's where at the money, so a 50-50 bet effectively. Market can only go down or up, and that's why the market puts a 50% level on confidence on that. But if we go out to the 25 delta puts on dollar yen, you can see that the implied volatility annualized within that week was at 6.8425%. Compare that to the calls, which are bullish, obviously, and give you the right to buy dollar yen over the course of that week on the expiry. And you could see that the market was prepared to pay less, or expecting a less relatively large move on dollar yen at 6.14%. So if you take this number away from this, you can see that the market is skewed on the bearish side. If you take that level of statistical probability out, to a really big move, the 10 deltas, a 10% chance of being out the money, which we used on that strangle, you can see here that the implied volatility is significantly higher than what we see on the put. So people have been saying, we think that there's going to be a much bigger move to the downside than to the upside as we go in through the week. So again, we're looking at that situation. And gold's a really interesting one now, because if you were to look at the risk reversals in gold, you can see here on my spreadsheet, they're at 3.7%. So call volatility is significantly more expensive than put volatility. In fact, if we skew rank that from the implied volatility rank, that's at the 91 percentile. So the market has been paying for call volatility. And actually, this is, I think, one of the best ways of looking at sentiment in the market. What is the skew of call volatility relative to put volatility? And you can see in gold right now, we're pretty much near, well, not a million miles away from record highs, which tells you that there's a lot of love for gold. And that's where this spreadsheet comes in. It tells me what the market is positioned and where they expect to see the direction coming through. So this does give you a sort of a directional bias where the market sees the potential going. But we came into the beginning of the week and we looked at dollar yen. Where's the options market seeing the risk for this week? And that's why this risk reversal or the skew is really important for me. We can I can see we're getting on for a bit of time, but if we look at that skew there, the difference between the 25 delta calls and the 25 delta puts and the differential between the two, we can actually look at that as a number in itself. At that number works out to be negative 0.6975. And actually, that chart looked quite interesting. It looks like it's really steep. Like people are paying a lot more to that, but we can put context on this by putting a chart out here. And from time to time, I'll put charts out around this, giving context to people who are on the distribution that I send out every day. And you can see here, while it looked quite dramatic when we actually chart this, the skew wasn't actually that much extremes. We tend to see the market paying up for put volatility because people have been expecting downside for some time in dollar yen. You can actually see these getting below negative 2. That's where the extremities lie. So at 0.6975%, yeah, fine. People were skewed for downside move in dollar yen throughout the week, and that sort of played into my view. But it wasn't particularly any kind of extremes. And then what we saw is on the Fed meeting itself, you can actually see we saw a little bit of a pop. I guess that's probably because they said that we're in a mid-cycle adjustment. The market didn't like that situation. But then what we actually saw was a big move down in dollar yen. Why? Because the market saw something that they hadn't actually already anticipated on the Monday. And that's where it's really interesting with implied volatility, because while it looks ahead at everything they know, it is everything that they know and expect. And what we hadn't been expecting was for trade tensions to start ramping up, and then the market has to, therefore has to reprice itself. And you know, we saw this big move down. So when we get new information into the market has to react, it has to adjust, it has to try and understand what that actually means. In the beginning of the week, we hadn't been anticipating trade tensions to be coming back in. In fact, the trade truce was at the back of people's mind. People were seeing some signs of better data in the US, and that's why they obviously only cut by 25 basis points as opposed to 50 that a lot of people were hoping for. But you know, actually on the day when we saw this as part of our risk assessment using this process, we actually only saw a little bit of a pop, and that sort of played into the idea of what we saw with those potential moves. Remember, I said that the market saw with a 68.2% level of confidence only about a 70-point move on the week, and that was playing out quite nicely. And then, of course, we got the Trump tweet, which startled the market, and that wasn't in the price. So when we're looking at this this process and what the market's expecting, up or down, it's only taking into consideration what you know, what you actually understand. As new news comes in, it has to be repriced and readjusts, just as we'll do with our spot FX trading and you know, trading on indices. So let's have a look at what this all means now in terms of the spreadsheet. So we get a better understanding about how this goes. We've got our realized volatility. This has happened, and we can still use this to great effect. If you've got a strategy that involves this, I think this just gives you that color. We've got Aussie, I mean, I can add or take away different crosses, whatever. I mean, it's very easy to get this information. You can see here that the average true range on the Aussie dollar over the last 5 days is 57 points. Compared that to the implied move over the coming 5 days, and you can see that the market is saying that's around 70 points. The implied move, and I took this on Friday, 8.71%. So what does that actually mean? Well, we know that that number there is the annualized at the money implied volatility with a 68.2% level of confidence. We can actually then put context around where that's been over the last 12 months and see that's 51 percentile. Okay, so the previous example I showed you on the Aussie dollar was from 2 weeks ago. This is from Friday. So we're trying to understand what this means. So again, when I look at the implied rank, we can see that's sitting mid-range. So it's, you know, going ahead for the next sort of 5 trading days, the market's not expecting big moves, 51 percentile. But then we can put that into our straddle price, you know, where we're looking at an at-the-money option strategy, the market neutral strategy, and the market is saying that they expect to see a 70-point move. Now we can put that into the system, we can from current spot prices, and therefore we can see that over the next 5 days, the market is seeing with a 68.2% level of confidence, statistically, that the Aussie dollar is not going to trade any higher than 68.66 and 67.26. Then we can ask the system using that strangle price for the options traders, go out and find me a strike which has a 90% chance of staying in the money market, the 90% chance that the price should not move or settle above that level. And you can see that at 69.07 and down to 66.72. So when I'm looking at the beginning of the week, I can say, well, actually, do you know what? This is probably the number I'll be using, but the market is telling me this is an extreme move. They see this as an extreme move over the week. So again, if you're just trying to understand how your algo is working or your EA is working or your discretionary position and where how much risk to take on, you know, most people would probably use an at the money strike, maybe use a 25 delta, but I would actually say to me, what's my worst case scenario? And my 90% is usually your worst case scenario. That would be an extreme move being priced by the market. So I know that beginning of the week that I might take on 118 points, and I probably wouldn't need to do 1.5 times that. I'd probably leave them, and I'd look then forward to find out where the next, you know, the natural point is to leave a stop. Where's a low? Where's a resistance level or support level or a resistance level? But the market is telling me there that there is a 90% chance that that the market is not going to trade any higher than that. We can have a look at these same situations for special events. You know, Brexit's an interesting one there. I can ask the system for the implied volatility for the 1st of November, which is one day after Brexit. And we can see that 11.86%. So what does that actually mean? I can put that into the system for that date and see that the market's expecting a move in cable of 575 points up or down. So it gives me my expected range. I can say, give me 90%. Now, of course, there's a lot of time going through to that period, which needs to be priced in, but I can see an extreme move being priced by that time of those levels there. We've got our risk reversals, which again looks at the skew. We can see here that Aussie dollar at the moment is skewed on 25 deltas. So a call with a 25% chance of being in the money and a put 25% being in the money. And you can see here that the market is skewed to the downside. They see more downside risks in the short term in Aussie dollar. And you can see that's around the 50 percentile. So it's in the mid range. So it's not particularly high. What is high at the moment is gold, as I say, 91 percentile. We've got euro dollar getting up to the 81 percentile. A lot of people have been buying euros because we've seen higher volatility in the market, and people therefore have been closing out of those carry trades. And the euro is the ultimate funding currency at the moment. You know, it's not because Europe's looking great. It's not. I mean, we've got political risk rising again. But people have been buying euros because people have been unwinding the carry trade, and you can see that now really quite resonating in the options market, where the call volatility is at the highest against put volatility, and in the 81 percentile. You can have a look at futures positions in the commitment of traders report, which is another way of looking at your risk reward assessment. And you can see how the market's positioned in the futures market. And if they're positioned like this in the futures market, you'd probably get to extrapolate that to what it makes it look like in the spot market. Have a look at gold, for example. The level of net long contracts in the market is 226,000. You can see the weekly change here, but you can actually see relative to that skew, the 12-month rank, that gold's 100 percentile. Now, you know, I'm trying to take a view on where gold is at the moment. Obviously, we can see the move that has happened on the daily chart or the weekly chart or any time frame. But you can see here that the gold positioning is at the 100 percentile. The risk reversals are at the 91st. It's telling me right now that there's a lot of love for gold, and if price starts going bearishly, then you might see that being capped. So I'm just trying to understand where the risk rewards lie, and I can see in two of these major factors that gold's got a little bit too much love, and perhaps buying pullbacks might be the way to go. And of course, that's where we start looking at price. We can have a look at what's happened in euros. So it's been a bit of a short covering, but the market's still short. Look at the pound though. You can see there the 0 percentile. So I've color conditioned these. Anything above 80 goes green, anything below 20 goes red. And what you can see here is that on sterling, we've got an extreme positioning. So the market holds an extreme bearish position on sterling, and rightly so. I mean, we're probably going to get a vote of no confidence coming up pretty soon in the UK, probably after the 3rd of September, after summer recess, and the market's very short the pound. But is this move now extreme? Well, of course, we'd have to look at those different charts to see. We can have a look at the start of the week, how the market's positioned in terms of the implied rate path. We can see that as we go into the September meeting, that the market's giving a 46% chance of a rate cut. Yeah, how does that play into my Aussie dollar trades? How does that play into my high yielding equity positions? We can see over the next 12 months that we're pricing in, well, nearly or just over 2 rate cuts. They tend to do it in 25 increments. You can see the Fed here, 121%. So the market's now saying for the September meeting that we've got a 50 basis point cut fully priced in. Sorry, a 25 basis point cut fully priced in, and there's a 21% chance that we're going to get a 50 basis point cut. So again, when I'm looking at this chart at the beginning of the week, it tells me what the market's expecting in terms of those moves, how the market's positioned in terms of the options, what the skew is in terms of the direction, the positioning, and also the implied rate path. And we put this out every Monday to clients and people who are on my daily report. So feel free to sign up. But I think this is what I use myself, just to give me a really clear understanding of what the market's expecting. So we talk about realized volatility. A lot of people use that very nicely and successfully. But for me, it's about what is the market telling me that's going to happen? What are the expected moves up or down? And what is the extent of those kind of moves? And we can actually put math and statistic to tell us those expected moves. So this is probably a lot of information for a lot of people to take in, and I'll be more than happy to sort of shed a bit more light on where this is all going. And I've got to wrap this up now for time purposes, but the whole point here is that we can use volatility and what the market's telling us about the outlook for our risk management to understand whether we're going to have potentially bigger moves, what the skew is, what the implied volatility, where the rank is, to give us that confidence about not just what the event risk is going to transcend into prices, but the confidence to trade in and out of those positions during the week. So that for me is more important than what's actually happened. I want to know what's going to happen and what the market's telling me they're going to happen, and we can find that out fairly easily using statistical situations there. So I'll hand it back to Boris. I think I did a job keeping it right into time. But
thank you, Chris. That's very, very interesting. I have one question, and maybe you could just scroll back to the dollar yen trade, because I kind of want to right there. That's fine. I want to just look at this chart from a trading perspective, because obviously what's very, very valuable from your analysis is that we can get exact mathematical levels of where the market thinks the price will go. So the next question after that is, and this is what's interesting to me, is once we break the top or the bottom of that level for the week, that presents, I think, a very interesting trading opportunity, because essentially, if you're a momentum trader, you could say market price was pricing, 70 points up, 70 points down. We're now, 80 points down outside of the bounds of expectation. That means something unique is happening, and maybe there's more continuation. So if you, for example, took a sell stop order at 107.70, which is pretty much, I think, where the level was, you had a really very, very nice trade here on a momentum basis, on a continuation list. You could also obviously trade this conversely and say, once it reaches that level, I'm going to be a buyer with a 30-point stop, because statistically, it's not priced to go much beyond that. But I just thought I think it's an interesting way of applying practical trading techniques using your data onto the charts. That is different from just the mere indicators and everything else that's coming in, because all of these indicators are essentially working off price. Your data is the only one that is expressing trader expectation, which is, both price and sentiment. That's what makes it, I think, so interesting. Would you agree?
Oh yeah, I'm 100%. I mean, but we've got to say that the markets are a living, breathing thing. We take on board everything that's going on, and we adjust and react, and that's why price moves. Of course, if we hear new news, that needs to be discounted straight away. And volatility changes straight away. Options prices change straight away. So we can the report gives us a snapshot at the beginning of the week. If new major news like we saw from the Trump tweet comes in board, we need to be able to react. And so all this really does is it sets us up for the beginning of the week, and what the market's looking ahead. We do need to react real time to that situation, and we all need to take a discretionary view. Whether that news is sufficient, and if the market changes and we see big moves in price, we react and perhaps we close positions earlier. But yeah, I mean, absolutely. I mean, if there's not a lot of new news, and you see these moves going up into the top bands, then you can take the view that we are due for a breakout in price, or you might say to yourself, well, actually, do you know what? We might see mean reversion coming through here, because we've got a lot of options expiries coming through. So yeah, that might be the level where it's, the elastic band's been pulled a little bit too far, and you might see sellers coming in if you've gone long. So yeah, I think there's a lot of ways to skin a cat in this situation, Boris. But I think for me, it's more about looking ahead over a course of a period, and actually being able to assess, put a statistical edge on what the market sees as event risk going forward.